Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for April 9th, 2017. Market breadth. With this past week's market fractional decline, our bull-bear point and figure ratio at 1.34 rose slightly from 1.31 last week, gaining strength, continuing within bullish territory. The total count of securities in bullish or bearish patterns increased 3% to 3,083. The count of bearish stocks increased 1%, while the count of stocks in bullish patterns increased 4%. The Pirls P&F Market Breadth Summary Chart shows us a market now 21 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 39 points for the 12th decline in 15 weeks. At a negative 33.95 points, it continues below all 7 tops above plus 100 and continues above all 4 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on lower average daily volume. Momentum, now at a positive 8.17, down from a positive 121.64 last week. The CCI 20 daily is now within the plus or minus 50 range for a valid zero-line reject long entry. The Woody's trend remains up. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 49 weeks ago, while the daily CCI 20 began a Woody's uptrend 20 weeks ago. The CCI 20 weekly has fallen to a positive 92.59 from a positive 94.86 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and 4 of the bottom 5 are negative. Summary: some tech, oil, and REITs on top, some tech and brokers on the bottom. Bullish, computer hardware continues in the top 5. REITs continues in the top 5. Disk drives has re-entered the top 5. Gold and silver has left the top 5. Bearish, KBW Bank and brokers continue in the bottom 5. Networkers has entered the bottom 5. Oil services and oil have left the bottom 5. Focus this week from www.wolfstreet.com. Great debt unwind. Consumer bankruptcies jump, first since 2010. Commercial bankruptcies spike. The following are some key points and charts. Don't blame the oil bust. Commercial bankruptcy filings skyrocketed during the financial crisis and peaked in March 2010 at 9,400. Then they fell sharply until they reached their low point in October 2015. November 2015 was the turning point when, for the first time since March 2010, commercial bankruptcy filings rose year over year. At first, they blamed the oil bust, but now the price of oil has somewhat recovered. Banks have reopened the spigot. Wall Street has once again the hots for the sector. New money is gushing into it, and oil and gas bankruptcy filings have abated. So now they blame brick and mortar retail, which is in terminal decline, given the shift to online sales. But brick and mortar retailers include countless smaller operations and stores that no ratings agency follows because they're too small and can't issue bonds. And many of them are even more distressed. Businesses file for bankruptcy protection because they have too much debt. Even brick and mortar retailers with little debt can get by just fine. Their sales might decline and they might not make much money, but they can keep going. However, brick and mortar retailers with high amounts of debt are toast. Total U.S. bankruptcy filings by consumers and businesses in March spiked 40% from February and rose 4% year over year to 81,590, the highest since March 2015. The Fed's monetary policies have purposefully encouraged businesses and consumers to borrow. But debt doesn't just go away. It accumulates. By now, an increasing number of businesses and consumers are suffocating under this debt overhang in an economy that never developed the escape velocity needed, and hyped by Wall Street for years, to outgrow this debt. The irony is thick. In all major sentiment surveys, economic confidence has soared since November. Consumers, owners of small businesses, and corporate executives are riding high on their own ebullience. But the economic reality is tough for businesses and consumers struggling under the hangover from 8 years of ultra-low interest rates. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull, Bear, Point, and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up. Wishing you a peaceful Holy Week coming up. And as always, wishing you true success.